Hi everyone, and welcome to another video in which I'm going to talk about purchasing options on Bitcoin and Ethereum. In my video I will tell you about the venues, I will mention what not to do not to lose money. I'll talk about the implied volatility, about how mark price is helpful, about the smile spreads, how volumes help you identify options which will be cheaper. Why fees are so important in the options market, and how skew.com can help you purchase options on the cheap. As always, please like, comment and subscribe. Please look at the links below. They will save you some money. So let's start with the venues. You should only purchase options on Deribit unless you have some really good market data which tells you that you should buy options elsewhere. This has been the case on FTX at some point, and I've tweeted about this, but overall Deribit should be your place to go. Binance options are a theft. They are only sold by Binance. You cannot sell options there, so you can only buy them, and as you can imagine, the prices are way too high. Don't sell options unless you really know what you're doing. The options have unlimited risk. If you sell them, and you need to hedge that risk, so unless you're checking and rebalancing every day, every hour, you should stay away from that. So first of all, what not to do, and what is so easy to do, is to do sloppy errors. Options, even on the mainnet, are quite illiquid, and if you go to some more exotic ones, you can see that a lot of options are traded at implied volatility of 500%, and you should never buy anything with implied volatility of 500%, or sell options with implied volatility of 0%, or anything low. So let's first see how to enable the view of the implied volatility. So you can see that the implied volatility is listed next to every price of an option. So these are Bitcoin options with very short expiry. So let's look at this one, which expires in 1 day. And you can see that these offers on the testnet and these offers on the mainnet, they all have implied volatility. And this is one way of pricing an option. So you can see people are selling them at implied volatility of 110% and buying at implied volatility of 99%. And the fair price is somewhere in the middle. Sometimes in the illiquid markets, it's less obvious. So for example, here, without tweaking the displayed values for the options, it's hard to establish, for example, what is the fair market value for this option. It's a put with the strike price at $18,000 because it's being sold at $95,000 and it's being purchased at $4. So to get the view of what is the mark price for that contract, you just press this button and you can see the mark price for every single option on Deribit, and that gives you an idea what is the fair value price. And this is also the mark price to which Deribit will adjust your margin requirements. So if this price is wrong and if you are running low on your margin, then you can be liquidated. So well, hopefully you will all keep large amounts of collateral on the exchange, because options can be very volatile. It's also useful to look at the open interest and positions, so I would always enable all these buttons. So what is implied volatility? A very good place to demonstrate this is Skew, which charts the realized volatility and implied volatility. So realized volatility is the volatility of the asset. Here is the Bitcoin volatility, and implied volatility is how options sellers price the contracts. So here you can see that more or less the volatility was somewhere between 56 and 70% before the big dump. And then after the big dump, suddenly the short-term volatility, which is 10-day volatility, jumped to 300%. The 1 month volatility jumped to 200%, and 1 year volatility jumped to 88%. And now they are all receding. So as you can see, the 10 days volatility after 10 days after the dump has started to go back to the normal values. It took 1 month for the 1 month volatility to come back to more or less normal rate. It will take 3 months for the 3 month volatility to kind of return to its normal after the big dump, unless there is another big price action. And then for the 1 year volatility, which went up from 70% to 80 to 90%, it will take 1 year for this to go down, unless there is a big price move, and that can push it up again. So how have the market makers been pricing these contracts? So on skew.com, unless you are an institutional client and you have access to the login, you can only view the 1 month implied volatility. And you can sometimes get some insights from skew.com on Twitter, and they have posted this, which is implied volatility of at-the-money options. And you can see that it all jumped, and now it has came back to more or less the baseline, actually below the baseline, because the volatility has been pretty high around July 2019. So by overall standards, the price of the options is rather low. It's around the average, more or less. So this is the implied volatility. It is the value that usually follows the realized volatility. However, in anticipation of big events like halving is a well anticipated and well you can say that it's at least partially priced in. But if there was an event like a statement from Trump about cryptocurrencies, about banning cryptocurrencies from US soil, which was scheduled like 1 month in advance, you would expect the implied volatility on the volatility curve to be high around that event, because whatever Trump says, like we ban Bitcoin from US, or make a statement that we put everyone into jail for owning Bitcoin, then in that case the price would somehow react and the volatility would increase. And that's similar for the earnings and some other events in the market. So that's what dictates the implied volatility. But in the Bitcoin market, it usually follows the historical volatility. So if the volatility was low, the implied volatility remained low. When there was a big price action, the implied volatility followed the big move. So that is the implied volatility, and it's a good gauge of determining what is the price, the true value of an option. It will be hard for a non-expert to determine whether paying $150 to buy an option for the 1st of May with a strike of $9,500, whether it's a good deal or not a good deal. But when you look at the implied volatility, in your mind, the Deribit has calculated this for you, and in your mind you can make a judgment whether 111% is cheap or expensive for you. In my view, at this current moment where we get some increased volatility, I tend to follow the I tend to agree usually with the market makers, and at the moment the priced in volatility is around 100% for short dated options, and it drops a little bit into the future into around 80% territory for the Bitcoin options. And that implies that the implied volatility will probably drop to around 60% when it's less volatile, but at the moment it is very volatile after the big move up to 9.5k almost. So that's the implied volatility. I don't expect majority of the options, like casual options traders, to to come up with the idea whether something is cheap or expensive on their own, but implied volatility is a good thing to look at. Now, so don't do sloppy errors, and Bitcoin options are absolutely ripe for doing silly errors. You can, for example, well, let's go to the testnet. So here you can buy an option at 500% implied volatility and sell an option at 0% implied volatility, and you can make a genuine and a simple error. Let's go to a place which has only one side being a steal. So here maybe well, both sides are a bit of a robbery, but if you want to buy an option at 0% volatility, so you can buy and sell options at a price at volatility. You go to the complex order form, you go to implied volatility, and you want to buy an option at 1% implied volatility. You press buy. Please log in. Okay, I am logged in here. So here we are. I want to buy an option at 0% or maybe 1% implied volatility. So I put an order and I buy. Great. However, if I go to another contract, which actually has some orders in it, oh, that's actually my order. Let's go here. So again, I want to buy one option with implied volatility of 1, and if it ever hits, it will be a great buy. However, I press buy, and then I want to place another one, but instead of buy, I press sell. Oh, actually this order has been rejected, but quite frequently these orders are not rejected. So let's go to something more realistic. Let's, for example, go here. No, this is implied volatility 0. We need to find something where a buy is, let's say, 20%. Oh, that's me. Oh, these testnet markets are quite illiquid. Okay, how about we try here? So I want to buy, so I press buy. Oh no, again, the volatility is, well, this will be good. So I want to buy an option at 1%, and this is my order, and then by mistake I press sell. Again. So yeah, these are some mispricing rules, not allowing to trade at these values. But trust me, it is really easy and really simple to just misclick. You want to submit a low ball order and buy an option, but you, I don't know, accidentally press sell. It happens to anyone. While in Bitmex USD XBT USD swap, this error will be fairly cheap because the spreads are relatively tight. The spreads on Bitcoin options are really wide, for especially on some exotic expirations. For example, let's look at the puts for December. Like here, the buy is at $4 and the sell is at $100,000. And imagine that you buy this put. So it's an option which allows you to sell Bitcoin for $20,000 on the 25th of December. And looking at the pricing here, this person is offering you this option for $95,000. So this assumes that you know, if you expect the price of Bitcoin go to below $100,000 in negative, you could buy this option, but you know, Bitcoin is not going negative. So you can see how mispriced are many of these contracts, and just don't make a mistake and don't buy a mispriced contract. So every time you press buy or sell, always double check. And these errors just keep happening, and Deribit has come up with mistrade rules. So if you do happen to do this mistake, and people have bought and sold me contracts totally mispriced, and obviously I didn't contact Deribit within 2 hours because I wasn't at loss, but the counterparty who is at loss can contact Deribit within 2 hours, and then the price of the option is adjusted. So for example, if the price is further away from the theoretical price of the option, more than 5% of the underlying, then the price can be adjusted. So you contact them. For example, if you bought an option at 0.12 BTC, but its kind of fair value theoretical price is 0.05 BTC, then you can request the price adjustment to 0.1 BTC. But you only have 2 hours to do that. So, if this horrible accident happens and you do happen to buy or sell an option at a price you don't like, then immediately contact them and they will reduce your losses. Fine. So we know what is the implied volatility, and that we should use implied volatility to decide what is expensive, what is cheap. Let's have a look at the order book and let's decide what is cheap. So let's look at the 29th of May contract, which expires in 1 month. And you can see that, well, actually this is not a great contract because it doesn't have high strikes, but this has high strikes. So you can see that some options are priced at 82% near at the money value. However, the options further away from the money are traded at 134%. Overall, if you kept buying options at this value and kept selling them at this value, you have made money. So why are these out of the money options so expensive? It's unlikely for Bitcoin price to reach $32,000, but if it does reach this value, it implies in itself that it has been really volatile, and the fair value of volatility should be way higher if, in any case, Bitcoin goes to $32,000 in 57 days, which is the expiry of this option. So this is the rationale for why the out of the money options are so much more expensive in the terms of implied volatility. They are less expensive in terms of dollars, but trust me, this is an expensive option, and I wouldn't recommend buying this option. So that actually brings us to the idea of a smile. So these are smiles. You can see that at the money, so this is the implied volatility curve on Deribit for September future, and the volatility is 80% at around 9 to 10k, and this is the current spot price, and this is the bottom of the smile. But as we go to the right side of the smile, the implied volatility hikes up, and as we go to the left side of the smile, the implied volatility also climbs up. So that shows that as we go to the sides of the smile, which is we go further away from the current spot price, the implied volatility will go up, and this is normal. So this is the normal kind of strategy of pricing options. So be aware that these options at the money are, in terms of implied volatility and in terms of fair value, which I believe is fair. So these options are cheaper than the options far out of the money, and keep that in mind. If you go all into these options, you will probably never see your money again. However, if the price goes to $50,000, then you have made a killing. This is, however, unlikely. Another important thing to look at are spreads. So the spread here is $30. You can buy this option at $660 and sell it at $633. And there is, well, it's obviously cheaper to buy an option and sell an option which has tighter spreads. So this one, for example, also doesn't have very tight spreads, partially because it's so volatile at the moment. This one has a spread of $20, so it's not too bad, but I'm going to tell you about a trick which can help you. This I've checked on the testnet. The testnet is quite liquid, so this will probably not work on the testnet, but it will work on the mainnet. If you want to buy this option at, so you want to buy this option, you have established this, you maybe have submitted, so let's bring up the fair value. We were at this option, yeah. So the fair value is 76% and this guy is selling it at 85%. So you have established that you want to buy this option, and to start with, maybe you were babysitting this and you've decided to put an order to buy 10 options at implied volatility of 7%, 70%, and you left it in the order book for, let's say, a few hours, and you are babysitting it and you are making sure that the price doesn't go away, that the price doesn't run away, and then in that case, if the price runs away, then your offer might be just eaten by someone. Well, it's actually more likely for the sell offers, because when the price moves away from you, you move to the side of the smile, and then implied volatility becomes higher. So this option, so this order, if it's priced low, it will probably never get filled if the price escapes away from you, but it may get filled if it becomes more calm and the price and the implied volatility goes down. So if you want to buy this option and the implied volatility is, so that the mark price is 75%, this guy is selling it at 85%. Actually, this is being sold at 99%, but yeah, let's just ignore that. So the mark price is 75%. You can submit this order at implied volatility of 70% and just wait. Maybe just wait for a day. Maybe nobody will buy it. At that point, you can make a more aggressive offer. So you can try to buy it at the current mark price, which is 75%. You can maybe even add a tiny bit, and then on Deribit it will actually be more visible, because options which are considered mispriced by Deribit are highlighted in red or green, and here it's a highlighted mispriced option. The mark price for the implied volatility is 101% for this contract. And this has disappeared and now migrated here. So the mark price is 105.5%, but someone is buying at a higher price, and the same here. So someone is buying at 105 while the mark price is 100. So if you submit something that is, if you submit a buy order that offers a price higher than the mark price, it will be in it will be highlighted in, this is highlighted in red. If you submit an ask that is cheaper than the mark price, it will also be highlighted. So, you know, it can just help some other buyers look at your offer, and maybe they'll just choose to take your offer. So you have tried buying that option at 75% volatility. Your option is highlighted against all the other options, and still nobody is buying. The next step could be to just market buy this option at implied volatility of 98%. However, on the mainnet, you might try just going in increments. So rather than submitting a buy for 0.012 BTC per option, maybe you can start with 0.9 and then you submit a buy, maybe with just 1 BTC, and then nothing. So you just up it, maybe 0.01. And at that point, the market maker can just fill in your order. He might decide that your offer is good enough, and this very frequently happens. So always try this, and this can happen at even much higher values. So you can get your full big order filled below the ask price if you just test it. So always try it. It has saved me a decent amount of money. And then, you know, if it doesn't work, it doesn't work. You just have to market buy, and you just market buy. And then you can wait for a while, and then maybe this ask will be repopulated, so that just don't continue chewing into that order book. Just wait and see what happens. It could be all good. The seller can repost the order, and you can get some cheap orders filled. So that's that. Volume is also an important feature. If you see decent amount of volume, it means that your orders which you leave in the order book are more likely to get filled. So these are expiring in 50 minutes, so that's not great, but these are expiring in 1 day, and you can see the volume here, and it will be highlighted by this. The volume is 200 options here, and you can see that the volume is highest near the current spot price, and that's because these options are the cheapest in terms of implied volatility, and this is why they get decent amount of volume. So if you submit an order in the order book here, it is likely that someone will give you a fill. However, if you go further to the December options, and if you go to maybe 20k option, the volume over the past 24 hours has been 2. So if you submit a buy here, it's unlikely that you'll get a fill, and the spread here is $50. So it would be nice to get a fill at such a spread, but it's unlikely. So the more volume there is, the more convinced you are that someone will give you a fill on your offer, and you can be convinced that these options are fairly reasonably priced. As you can see, there is pretty much no volume on these puts with high strike prices here. The volume is 1 or 0. Actually, this is quite surprising that someone has traded this. I'm now curious to see what price they've executed at. And the recent trade has been at implied volatility of 80%. So yeah, although there are no offers you can take in the order book, someone submitted an order in the middle and he got a fill. So on some exotic options like these, you can submit an order which is near the mark price, and maybe someone will give you a fill. Another important thing, and that can save you money as well, is the skew. So skew tells you, and this is this chart on skew.com, skew shows you whether people are buying calls or buying puts, more or less. Like, what's better priced, calls or puts. And why is it important? It's important because you can buy, so if calls are expensive, you can buy futures and buy a put, and it becomes a call. Because if you, so let's just illustrate this. So you buy a call at with a strike price at 10k, or you can achieve the same thing by buying a put. So you buy a call at 10k, and you can achieve the exact same position. So let's say that the spot is 10k, and you can either buy a call at 10k, or you can buy futures at 10k and then buy a put with a strike price at 10k with the same maturity, and then get rid of that futures at the expiry. This creates a synthetic call, and if skew favors you, this can be a very good trade. So here the skew has been favoring calls because everyone was buying puts after the big dump. They wanted to be insured and secure. At the moment, people are buying calls. So maybe if this pump continues, we'll have nicely priced puts. And maybe rather than buying calls, you will be just buying futures and buying puts. And let's have a look at the prices. So at the moment the skew is around 0, so we shouldn't really see much difference between the implied volatility of calls and puts. But trust me that at these levels it was really less expensive. The implied volatility was a few percent sometimes better. Well, the price was cheaper for the calls than it was for the puts. It was usually like between 1 and 3% of implied volatility. but it is significant, and if you are buying decent volume, then it certainly pays off. And probably the last question to answer, which expiry to buy, and I have no clue. It depends on your strategy, on your expectations. If you're buying options, then you have some plan in your mind. The overall way how options are priced is that the theta, the decay of the value of the option, favors holding long-dated options. So this is all priced in, but the decay of the value of the option is low at the beginning, and then the closer we get towards the expiry, the theta decay accelerates. But this is all pretty much priced in, so it's difficult to take advantage of that. If you think it's going to pump short term, then buy a short term call option. If you are looking for a long-term position, just go towards the September or December ones. Another thing to keep in mind is that the volume on the very long-dated options is rather low, so it might be actually more profitable to buy September calls rather than December calls, because the volume on the December is so pathetic, and that the spread is so high that it actually might be you might be better off going for the September ones. You can see that the volume is like around 500-600 options per day, while here it's barely 100. And that is pretty much it. I hope that going through all this will help you save some money. So remember, just don't make sloppy mistakes and don't buy mispriced contracts. And if you just take that away, it will be good. Thank you very much for watching. Please comment, please like and subscribe. Please look at the links below, which will save you some money. And going to my Deribit referral link at the bottom will save you, I think, at least 10% of fees on options.